So in this video, we're going to look at the perpetual method of inventory, and primarily with respect to accounts receivable and cash discounts, we're going to look at the gross method. And the case we're going to be looking at is with respect to is banana hangers. And again, you can find that case attached to this, so you should pause now, print that out, and read it before we get started. And you can also find it on Blackboard. So we have two companies. The seller is banana hangers, and you'll hear me pause every once in a while when I say banana hangers and start to laugh, just because I think it's slightly ridiculous. And the buyer is Crazy Kitchens. So Crazy Kitchens, they love these banana hangers. Boy, they sell them a whole bunch of them. So the first transaction that happens is that Banana Hangers has sold 200 of these banana hangers to Crazy Kitchens. So the first journal entry that we're going to record is an accounts receivable of $500 and a sales of $500. And this is the 200 banana hangers at $2.50 a piece. And again, as normal, we're going to record the cost of goods sold, and their cost of goods sold is $1.50 a piece. So, and take that out of inventory or credit inventory. Okay, so there's the sales transactions from, and this is the side. When we look at the left side here, we're going to be looking at banana hangers at the company. Okay, all right. The next transaction is we have some shipping costs. The shipping are reported as FOB shipping point, so no journal entry required on the shipper side. No journal entry required, because if it's free on board shipping point, what that means is that the purchaser is paying the shipping charges. Title has transferred at the shipping point. Okay, then we have some sales returns. They returned 50 of these banana hangers. They were tilty. You put the bananas on them and they just fell right over. So they had to return some of these banana hangers. They returned 20 of them, defective dang banana hangers, and so they returned them. And so we're going to record sales returns. There's 20 of them at $2.50 a piece. That's $50. And we're going to then credit our accounts receivable because they no longer owe us this money. And for the sake of this problem, we're going to ignore the shipping charges and all that stuff with regard to the returns. We also need to put these banana hangers. At this point, we're going to go ahead and put them back into inventory. And credit the cost of goods sold. If we need to, maybe we can rework them and sell them to somebody else, or maybe we'll have to just scrap them, but we'll work on that later. And then Crazy Kitchens actually paid us, and they paid us within the 10 days because they got a 4% discount for paying within 10 days. And that's a hefty discount. So how do I calculate that? Well, they owed us $450 at 4% discount. That's $18. That's a hefty amount there. So they're going to pay us cash of $432. The amount that they owe us, the accounts receivable, was $450. So we're going to credit that, and we're going to debit what we're going to call sales discounts. Sales discounts is an income statement account, and it is recorded as a contra account, contra to sales on the income statement. Okay, so those are the journal entries for the perpetual growth method for banana hangers. So let's now do the other side of the transaction, and let's parallel this up. And what would Crazy Kitchens side look like? Okay, so when Crazy Kitchens bought these banana hangers, they were going to put it into inventory, $500, and they're going to have an accounts payable. And this hopefully this makes sense to you that one company has an accounts payable and one other company has accounts receivable, and they do match. All right. We have no transaction with regard to, in the purchase transaction, we only have one journal entry. Again, for banana hangers, they're going to have two journal entries because they have to record the cost of goods sold. Okay. Now, with regard to the shipping charges, we are going to have a journal entry on the Crazy Kitchen side. And under a full absorption method, which is required under GAAP, all costs required to get a product available for sale have to be absorbed into that product cost. So these shipping charges of $200 that we're going to pay Federal Express will all go and be a part of inventory. Okay. 3, we're going to have a sales return. And if we record this on our side, we're just going to reduce our accounts payable by $50 and credit inventory. So we're going to debit accounts payable and credit inventory. Now, if they pay within the 10-day period, which Crazy Kitchens did, how much cash are they going to pay? Well, they're going to pay out in cash $432. Their accounts payable is going to go down by $450 because that's how much they owed. Now this $18 right here, this goes into inventory. Okay, so basically this is, when we take a cash discount, it's not a lowered expense. It goes all into inventory. Again, this is all part of the cost of getting the inventory, or less cost in this case, of getting the inventory ready to sale. So these are the journal entries under a perpetual system using the gross method for cash discounts for both the buyer, Crazy Kitchens, and the seller, Banana Hangers.